complacent. Act right or act out, the choice is always clear. My presence is my power, my standards draw the line here. Elevation, protocol, rising above the chaos, taking control. My value's not negotiable, my worth is my law. Surrounding myself with excellence, that's what I saw. I'm not building walls, I'm building bridges to greatness. Demanding excellence, no time for complacence. Act right or act out, the choice is always clear. My presence is my power, my standards draw the line here. This is the elevation, protocol, rising above the chaos, taking control. My value's not negotiable, my worth is my law. Surrounding myself with excellence, that's what I saw. This is the elevation, protocol, rising above the chaos, taking control. My value's not negotiable, my worth is my law. Surrounding myself with excellence, that's what I saw. I'm not building walls, I'm building bridges to greatness. Demanding excellence, no time for complacence. Act right or act out, the choice is always clear. My presence is my power, my standards draw the line here. I'm not building walls, I'm building bridges to greatness. Demanding excellence, no time for complacence. Act right or act out, the choice is always clear. My presence is my power, my standards draw the line here. Bridges to greatness, demanding excellence, no time for complacence. Act right or act out, the choice is always clear. My presence is my power, my standards draw the line here. I'm not building walls, I'm building bridges to greatness. Demanding excellence, no time for complacence. Act right or act out, the choice is always clear. My presence is my power, my standards draw the line here. I'm not building walls, I'm building bridges to greatness. Demanding excellence, no time for complacence. Act right or act out, the choice is always clear. My presence is my power, my standards draw the line here. My standards draw the line here. My standards draw the line here. I'm not building walls.
All right, ladies and gentlemen, welcome to This and That. We like 10 minutes, 15 minutes late today. You know, time just got past me today, man. I was doing so much stuff. Not gonna lie. So it's not as much stuff as I normally would have had to do from like 2 years ago, because I have really consolidated my my work schedule, but it is still far more than what I would prefer. So here on This and That, where we talk about this, that, and everything in between, we're live 7 nights a week. And while we do not let the sun rise without going live, we don't always start on time. So we ask you guys to like and subscribe, and then also hit those notification buttons, and uh, make sure that you go and check out the membership. I just put in the list. So we're talking about in a day right now, but I just put out the list in the membership for the dividend rotation strategy for April and May. I failed to provide that questionnaire uh, for Steven because I ran out of time. But I got nothing to do. Let me double check. I think I have nothing else to do after tonight's show, where I can get a lot of things done tonight. The first, yeah, I got quite a few hours after tonight's show to get some stuff done. So I'm going to be getting those templates up there for Steven. I swore on it last night, but I'm going to get it done tonight. You know, when you got a lot of things to do, what I said before, you got to find 5 things, 3 that are not that important, 2 that are major, and then you try to get at least 1 of the 2 majors and 2 out of the 3 minors, and then whatever you didn't get done, you roll over to the next day. But by the end of the week, you should have all 5 of those things done if you did 1 thing a day. So I had to roll it over for 2 days already, but I'm going to get it done because it's 2 days after he asked a question. But we're going to get it done tonight, and it's going to be up there for tomorrow. I had some extra clients come in, and that's really what happened. It put me off because I had new workload come in that offset my ability to get stuff done. So uh, we're looking at, after we covered the topics from yesterday, we're still under war. We still have the DHS shut down, and feds have settled down with the interest rates and everything. So we're going to be talking about how that stuff works tonight. While we're live 7 nights a week, we start off with our questions and comments from the fans on Sundays. Monday, Tuesday, and Wednesday is business and politics, where on Monday we talk about how politics negatively impacts your ability to make, save, and invest money. On Tuesdays, we talk about ways to invest, ways to save, ways to budget, ways to make money, either in person or virtually, so that you can expand your options. Today, we're going to be talking about the stocks that you should be paying attention to for the next 60 days. But as we go into April, because the first is in the morning, I'm going to be letting you guys know which ones are coming up. We missed the one that was available for April 1st, but we have enough time April 1st to bid on anything that's coming up for April 3rd. So we're going to be talking about those so that you guys are aware of what's coming up and what you can benefit from, because these are dividends that pay shares. If you buy the stock before the dividend date, you can hold it if you want, or you can sell it if it's up. But if you have it when the ex-dividend date rolls over, you get paid, preferably this month, either by the end of this month or the whatever the next payday is, because sometimes the payday is like a week away from the ex-dividend date. Sometimes it's 3 weeks away from the ex-dividend date. Sometimes you get it at the beginning of the month. Your ex-dividend date at the beginning of the month, your payout date might be at the end of the month, and sometimes your ex-dividend date is at the beginning of the month and your payout date is at the beginning of the following month. But a lot of these are monthly stocks, which means that they're going to pay every month. Some of these are quarterly stocks, which means that they're going to pay every quarter. And the quarterly stocks might have a larger gap between the ex-dividend date and the payout date, whereas the monthlies will have a shorter gap because, I mean, they pay out every month. So we're going to be giving you that information today. Wednesdays, we give you guys information about different countries around the world to invest in and potentially to live in, what the culture looks like. We just covered Cuba last week. Wasn't a good idea, but to go to, because it is rough. Not every country is going to be, marshmallows and rainbows and stuff. Some of them are not going to be the go-to for certain individuals. So we try to cover each one of them and let you guys know which ones are in the list of to-dos and which ones are not. Typically, we understand that some of the top 5 countries are over there in Asia because they're 30% of the cost of living of America, and the Eastern culture is still more traditionally family oriented, back like in the 1920s and 1940s style, which the women were more modest. And even though they do incorporate the feminine independence out there and self-sufficiency, they're still more modest and they're still more family oriented, where it's like, I'll work and be at home, like in the relationship and with the family and stuff, as opposed to, I'm going to run the streets and no kids kind of mentality. So there's like all of the countries that are like the top 5 are over in Asia, but we cover all the countries around the world. So whichever ones we hit on, And we're going in different regions, so we're not in the same place all the time. We don't just cover one continent for half a year. We cover like different areas at different times of the week, at different times of the month, to make sure that we're touching base on everything as soon as we come across some relevance. Now, after that, Thursday, Friday, and Saturday, we give you guys information about how to fix yourself, how to improve yourself. So self-improvement, self-development, relationship discussions, uh, negotiations, socializations, building your brand. We've got a show coming up. We talked to you guys about how to advocate for your promotions, raises, retirement packages, severance packages. We talk about all these things, how to incorporate these things in there so that you can have the best in and have the best out. Because like a lot of the times, people believe that, I'm entitled to a raise and I'm supposed to get one automatically. No, the same way your credit score might look good and you might qualify for a credit increase. Not all the time do you automatically get one. Once a year, you have to reach out to your creditors and be like, hey, can I get a credit increase? When they look, they might just give it to you just because. But the ideology is that because you asked, you got it. If you wait till they give it to you, you may never get it. Some have automatics. Some companies have automatic promotions, automatic raises. If you work here for a certain number of days, or you automatically go to the next level. If you work here for a certain number of years, you automatically get a quarter raise. Those are automatic. But if you want like an extra boost, you got to ask for that. So we discuss different ways to make these things happen. So since we don't have a lot of stuff going on, because we do still have to cover what the hell happened with the responses and retaliations from Spain. So we're going to be trying to cover that on next Monday's show and getting all the juicy details about that. Let's go ahead and get started with today's discussion, because it does feel like the market is making a massive mistake right now. And I don't know if anybody's paying attention to what's going on, because as we head into the second quarter of 2026, most investors are doing one of two things. Either they're still chasing high flying AI stocks that shot the lights out last year, or they're still sitting on the sidelines, paralyzed by the headlines and inflation and global turmoil. I mean, special shout out to Steven. He's still on the sidelines because he's paying off credit card debt. And I would not be on the sidelines. Put something in there, man. Put something in there, man. If you were doom scrolling on your phone and you found anything that you considered buying for the moment, you talked yourself out of it, whatever the price that was, take that amount of money and put it up on the brokerage account, because you honestly could, as little as $10-20 a month. It's not how much it is the fact that you just start doing it that is really important. And once you start doing it, you start seeing the value in it. And once you start doing the calculations and seeing the value in surplus investing, that's when you start putting in larger quantities of investments where you prioritize investing. The old saying, and Michael says this all the time on the show, special shout out to Michael. Michael says it on the show on a regular basis: always pay yourself first. That mentality means that you take money out of your paycheck and you put it somewhere for your money to make money for you first, and then take the rest of it and manage all the bullshit you got going on with your daily life. So if you are in a situation where you're going to pay yourself last, where you're going to take your paycheck and you're going to do as much stuff as you can with your paycheck, and then whatever you don't have enough money for, you're going to roll that financial problem over to your next paycheck, but you never pay yourself, you're going to find yourself in a position where you're never getting off the ground as far as building your future. Because your future starts with you investing today. Now, I understand when you have big financial moves you're about to do, instead of you investing in your accounts, you might decide, well, I'm going to hold this so that I can pay for this, I can pay for that. If you decided to buy a house, you got to take the money out of your immediate cash savings and put it towards the down payment. You got to pay for movers. You got to pay to activate the utilities. You got to pay to do this, pay to do that, pay to do the other. These are the things that you've got to do in order to make sure that you're set. Now, after you got that done and you're back stable, where you've already made your moves, you already paid for the movers, everybody's done, all the bills are set up, you moved into the place, you got settled in, all you got left is debt coming in and or money coming in and debt going out. You pay yourself first and then pay your debts. Because whether you pay the minimum balance of your credit card and then put extra money into your brokerage account, or you pay the whole credit card down, does not do anything other than change the way your future is going to be. Now, I understand if you're like, I'm looking at stocks right now that are like 20%, 21, 22%. But if your credit card is 29%, you might say, man, look, I'm losing money only paying the bare minimum on this card versus how much the opportunity cost of making money from the credit cards that I mean, the stock options that I would have been investing in. And I can understand the math, but I can also understand that the only reason why you're losing more money is because that 29% interest is hitting a balance that did not move. I told you guys before, if you're not at 99% of your balance, you're at 40%, 50% of your balance. You don't always have to pay the whole balance down, but what you could do is you could take your primary bills that are monthly bills, monthly reoccurring bills, and you can put those on whatever card that's got the most space on it with the furthest due date, the furthest due date for the end of the billing cycle, not the furthest due date for payment, the furthest due date for the end of the billing cycle. So if we're tomorrow's the first, if your billing cycle ends on the first, you want to come the first, top out that card, bring it up to about 90% because the billing cycle rolled over. So on the second, you want to top out that card, pay all the bills that you can pay with the abilities that you, without overdrawing the card, of course. And then the cash that you would have spent on those bills, you use that for the card that's due on the 15th and pay that card down so that its balance is as low as possible, if not like $2. When that card billing cycle rolls over on the 15th, on the 17th, then you take all the stuff that you would have paid for out of your next paycheck and charge it to that credit card. Gas, car insurance, phone bill, anything that's due at the end of the month, anything that's due at the beginning of next month, you want to charge it to that card because you got 30 days before that card rolls over, right? Now, in doing so, even though you're floating the balance from credit card to credit card, you're only being charged interest on the $2 because the interest is hitting whatever is left over on the account when the bill rolls over. The interest is not hitting whatever got paid off. Anything you put on the card during the billing cycle and pay down doesn't get hit interest. So if you've got $2,000 that you're floating from credit card to credit card where you got $3,000 or $5,000 worth of credit that you can utilize, and you're moving the money around, and your paycheck might be $2,500, your paycheck might be $3,000 or $4,000 a month. If you roll that money around, you're not getting hit with interest on that. That's the equivalent of 0% interest on these cards. Then the benefit that you experience from that is you can eventually pay that down, but you can also pay yourself first. You can take $25, $50, $75, put it into a brokerage account. You can pay down the card before the billing cycle rolls over. Then you can charge the card to 90%. And I say 90% because depending on what card you have, if it has a monthly fee, if it has an annual fee, you need to have that room for that fee to hit the card before the balance, before the billing cycle rolls over, so that it doesn't, you had $1,000, you put $999, and then it charged you $30 for the service fee that it charges once a year, and now you're overdrawn. We don't want you to overdraw. If you have 1,000, you want to put like 800, 850, maybe 900 at the most, and leave it there. That way you've got that $50 or $65 available to, just in case the card charges you a service fee that it's supposed to charge you based on your agreements when you signed on. That keeps you from having to deal with unexpected shenanigans. But that allows you to use 90% of your credit to take the cash and do more stuff with. And when you start putting more cash into your brokerage account, you start building up your brokerage account, you start finding yourself in a position to have the motivation to continue to do that. Now, the other thing that's going to happen is, like I said before, because if you're paying bills in advance, over paying on certain things, you'll find yourself in a scenario where, oh, light bill's cheaper than I thought it was. Got an extra $50. I can put that extra $50 on my credit card and pay some more of that debt down, you'll find that credit card disappearing. And the reason why you find a credit card disappearing is because you're putting you're going to take a specific quantity of money, put it into your brokerage account. You're going to take a specific quantity of money that you have to put on your rent, because usually rent and car notes are like the two things that are usually primarily required. Mortgage is the three things that are usually primarily required to be done directly to your bank account, cash. But because a lot of businesses, dealerships, and everybody like that does online banking, the third party payment option still allows you to charge it to your credit card, but they do charge you a convenience fee. If you don't want to pay that convenience fee, link your bank account, pay it from the bank account. But those are the three things that you're paying directly. So if you're paying your mortgage, after your mortgage, whatever's left over, you take a piece of that, put it on your brokerage account, put the rest of it on your credit card, roll the bill. That's what you do. Charge everything to the card, roll the bill. By doing this, you'll find that the bill goes down because you're going to bring it down to $4, but it's only going to go up the mandatory bills that you're putting on that card. So you're no longer going out to the club. You're no longer drinking with the bros. You're no longer frivolous spending. So once that line item is paid off, it's not going to be on next month's bill, because the only thing going on next month's bill is whatever lights, water, cable bill, phone bill, gas bill, car insurance that you didn't put on the other credit card. That's what's going to go on the next card. So you'll find yourself paying these credit cards down faster and then making it a habit to keep them at like $2 to $5 on each card. Then you're also going to find out, oh shit, I got this huge line of credit, which means I could probably put $500 on my brokerage account this month, right? So don't let the fact that you got debt, the fact that you got student loans, the fact that the economy is up in the air with all of the tariffs and wars and political disarray that's going on, because while this is going to distract a lot of people, a predictable and powerful cash flow opportunity is being completely ignored. And dividend paying stocks are ones that you buy and hold even in the decline of the market, because a growth stock like Tesla, you buy a share of Tesla for $400. If the share goes up, your money goes up when you sell or if you leverage against it. But when the stock goes down, you lost value. So if you sold, you lose whatever is less than what you paid for. But there is no reason for a dividend paying stock for you to care about that, as long as the company doesn't go under. If you're buying a stock that was $10 a share, it went down to $5 a share, but it's paying 10 or 15 cents a share in dividends. If it's $5 a share, now's the time to buy in, because it's still going to pay you the 10 to 15 cents of dividends, no matter what the value of the share stock is. When it goes back up to 10 or 15 after the war is over and everything to that effect, you're still getting the 10 or 15 cents a share. But the difference is that your $10 a share when you was buying it in Christmas is now $5 a share in April, and you could be getting 21% interest off of it instead of 17% interest off of it. That's the difference. Special shout out to Negative. He says, bullish thoughts on the AI recession. I don't have any thoughts on AI recession, specifically because that's not what we're talking about today. I also don't have any thoughts on the AI recession for the other reasons why we've covered a lot of things related to AI, and AI is not receding. AI is doing the good. So employment is receding in AI, but not the share values in stocks and companies. There are a couple companies, like I think it was Anthropic, that got terminated on that Pentagon contract. They're kind of in a dip, but Oracle and other companies that got together and bought out TikTok, yeah, they're not sucking right now. Companies like Tesla, they're doing fine right now. Their BBAI is doing okay. Nvidia's doing good. OpenAI, Microsoft, Google, Amazon. There's so many companies that are doing good right now. Meta, Facebook, Instagram. There's so many companies doing good right now. I can't talk about a true AI recession. Now, because some of the bills that were passed with the big beautiful bill, or some of the laws that were passed with the big beautiful bill, did change the way oh yeah, look, Starlink. And like Michael said, you'll still hold the stock. You'll still hold the stock. So yeah, Starlink, so companies like that, like they're doing fine. It's just that their employees are getting laid off. So because technology is replacing manpower, right? So I don't have any thoughts on an AI recession. But if I find some information about there being a true, factual AI recession, I guarantee you negative, I'll cover it on the show. Now, to understand why, I selected about 23 out of the, you see some of them going across the top of the screen. 23 out of the, I think, 54 stocks that we have in our core satellite portfolio, because we have 23 cash dividend stocks, and then we have more that are growth stocks, because I thought it was only fair, because you got stuff like Netflix and other things like that that are growth stocks. You don't get dividends from them every month, but they do gain in value on a regular basis. So it makes a good assumption that you can get in there and buy that stock and gain value in your portfolio. And then if you're doing things like lines of credit towards your stock portfolios, where you're putting a lien against your stock portfolio and borrowing money against the portfolio to buy things in cash, and then having your portfolio pay it back, or you pay it back, then a growth stock is beneficial for you, because growth stocks can increase in value in some situations more significantly than cash dividend stocks, not real estate investment trusts, at least not right now. But overall, it is kind of possible. So the ideology is that we want to keep an open opportunity, but I want you guys to recognize, these 23 stocks we're going to talk about today are so compelling, because we first have to get a handle on the specific economic storm that we're in right now, because this isn't 2023, and it is definitely not 2025. This is a unique environment. And that is where the opportunity is, because a unique set of market conditions created a rare pricing dislocation. So we're seeing durable income generating stocks being tossed aside at incredible discounts. And the fear in the market can be at your advantage. In tonight's show, I'm going to be pulling back yet another curtain on my personal Q2 wish list. And this isn't just a few ideas. This is a deep dive into 23 specific real estate investment trusts and BDCs, and energy stocks as well, with yields that go all the way up to and beyond 15%. So these are the companies that I believe that are profoundly mispriced for the reality of today's market. First, let's talk about the Fed. After a relentless hiking cycle, the Federal Reserve is on an extended pause, holding the federal funds rate steady in the 3.5% to 3.7% range. And they aren't cutting rates aggressively because of inflation, while down from its peak has been sticky, hovering stubbornly between 2.5 and 3%. So to complicate things, the labor market is finally showing signs of softening. Unemployment ticked up to 4.4% in February, and we saw some surprising job losses, which made the Fed's next move even harder to predict. Michael said, you mean he looks crooked? Possibly. Possibly. So let's look crooked. We have a higher for longer rate environment right now, but not one that's actively getting tighter. This has caused a huge shift in the bond market. The 10-year Treasury yield, a benchmark for all other investments, has stabilized right around the 4% mark, like 4.4, 4.1. But for the first time in ages, you can get a respectable, nearly risk-free return. And this 4% is our new hurdle rate. Any investment that you make has to offer a serious premium over that to justify the risk. The second factor is a massive rotation in the stock market. The AI mania that defined 2025 has hit a wall of valuation concerns. Like somebody just asked me about the AI recession. At the same time, geopolitical tensions have triggered an energy shock, with Brent crude prices surging, having crossed over that $100 per barrel mark earlier in the year. And what we talked about on Monday, this mix has sparked a powerful rotation out of growth stocks and into value sectors. Now, we're seeing money flow in the energy, utility, and small caps, while the mega cap tech stocks are finally taking a breather. And I believe that would kind of link towards the AI recession observation. Lower risk, high reward. Exactly. That's kind of what I was getting at. It went from high risk, high reward to lower risk, low reward, or lower risk, high reward. The reward stays up there, but the risk has gotten a little bit less. And this is going to be where the herd mentally creates an opening. Investors are either clinging to last year's tech winners or running to perceived safety of treasury bonds. In doing so, they are pushing anything they see as rate sensitive or risky away. They're selling off whole sectors like real estate investment trusts and BDCs without a second thought for the underlying fundamentals. They see higher rates and just assume all income stocks are toxic. That's a mistake. Here's the solution: portfolio of carefully selected, high quality, high yield assets that are trading at an extremely high discount, precisely because of these macro fears across the market. The market is giving us a chance to lock in huge yields on companies with durable cash flows that more than compensate for the risk. If you're locking in on 21 and 22% right now, you're going to forever have those shares at 21 and 22% as long as you don't sell them. So unless they split the dividend distribution, you're going to forever get that amount of money for the remainder of the time that you hold those shares, right? You just have to know where to look. Lucky for you, I did the looking for you. So let's get into the list. We're going to build this watch list like a pyramid. So the foundation has to be rock solid. And these are companies with attractive, safe, and growing dividends. They won't have the shocking double-digit yields for later picks, because our later picks are going to have these really huge returns, but they do provide stability and a total return that makes them undervalued in a market obsessed with extremes. And their yields are comfortably beating inflation and offer a strong premium over cash. Now, I'm going to throw these up here for y'all so that y'all can see which ones we're talking about. A lot of these are going across the screen tonight, and the whole list is in the membership. First up is a name that everybody knows, which is Johnson & Johnson. After spinning off its consumer health division, Kevin, the new J&J is a focused powerhouse in pharmaceuticals and medical devices. This is a divided king or dividend king, okay? So a company that has increased its dividends for more than 60 consecutive years, you got to pay attention. In a shaky market, that kind of track record is priceless. The thesis is simple: defense of an undervaluation. While everyone else is chasing speculative growth, Johnson & Johnson is a fortress of financial strength. In a softening economy, demand for its life-saving drugs doesn't just disappear. it continues to grow. And this spinoff streamlined operations, allowing for a laser focus on its high margin drug pipeline. Michael says PNG. There you go, PNG. The risk is always a clinical trial failure or a patent cliff. But Johnson & Johnson's pipeline is one of the most diversified in the industry, which helps cushion the blow from any single drug's failure. It's a bedrock asset for an income portfolio. Now, number two is going to be Oracle Corporation. Now, I have, like I said in the membership, the ex-dividend dates or approximations of ex-dividend dates in the membership for all of these stocks that I'm putting on the show tonight. But I want you guys to take a look at these, because next is tech stock, but not the kind that you're thinking about. Oracle represents mature, undervalued tech. With a current yield of only around 1.4%, you might ask why it's on an income list. Answer is dividend growth and a pivot to durable cloud revenue, because Oracle is one of the ones that owns or manages the TikTok, the multi-trillion-dollar industry. Oracle is a cash flow machine trading at a huge discount to its hyper growth peers. The why now is the market's obsession with AI hype. Oracle is quietly building its Oracle Cloud Infrastructure, OCI, business and winning major clients looking for secure, high-performance cloud solutions. While starting dividends is modest, the payout ratio is very conservative at under 30%, leaving massive room for future dividend growth. The company is also consistently buying back shares. The risk is obviously the brutal competition from Amazon, Microsoft, and Google. However, Oracle's deep roots in enterprise and its specialized database tech give it a sticky customer base. This is why a play to the cloud trend without paying a crazy valuation is a fantastic decision to make, all while collecting fast growing dividends. He said, Lenny Pharmacy Insulin, buy and hold. There's another option. I'm giving you dividends. He's giving you he's giving you a lot of other stuff. If you take insulin, you should have insulin stock. Now, we get to the energy sector, right? Because we've covered this before. So we've been covering this since Venezuela got captured. And this is going to be the epicenter of current value rotation. ExxonMobil is the first of our energy majors. The cash for Exxon in Q2 of 2026 is crystal clear. It's a free cash flow monster that's fundamentally undervalued by a market still hungover from a decade of poor returns in the energy sector. So with Brent crude having sustained a price over $100 a barrel, Exxon is generating staggering amounts of cash. The company has completely transformed, focusing on capital discipline and shareholder returns. They're no longer chasing growth at any cost. Instead, they're developing higher returns, low-cost projects in places like Guyana and the Permian Basin. The current dividend is around 3.5%, but that's only half of the story. The company is also buying back shares hand over fist. The primary risk is oil price volatility. If a global recession hits or geopolitical tensions suddenly ease, oil prices could fall. However, Exxon has slashed its break-even cost, meaning it stays highly profitable even at much lower oil prices. A key detail the market is currently ignoring, especially with the Strait of Hormuz in the middle of the war right now. Now, everything I just said about Exxon applies to our next pick, Chevron. Think of them as the twin titans of the new disciplined energy era. Chevron also yields around 3 to 4% and is aggressively returning cash to shareholders through both dividends and massive buybacks. What makes Chevron show so interesting right now is its incredible operational execution. The company has a portfolio of great assets with low declining rates, meaning that they don't have to spend as much just to maintain the production. That's going to translate directly into more free cash flow. Just like Exxon, the main risk is a short drop in commodity price. However, Chevron, especially aiding in the takeover of Venezuela, the Chevron's going to be benefiting from that. They boast a low break-even price and a pristine balance sheet that can weather any storm. So, in a world starved from real assets, real cash flow, owning a company like Chevron is a powerful hedge against market frost. He said that Chevron's down 11%, and that means that you're buying it 11% cheaper. This is what people don't think about. People think, oh, when it's up, I should buy. You should buy while it's down because it will go back up. And when it does, you're going to get that 11% plus more. Michael says stock is $169 today. Now, I want you to keep doing that, Michael, as we go through, because when we get to those BDCs and we get to those REITs, you're going to be like, holy shit. Michael's going to verify for y'all exactly what I'm telling y'all in the moment. Like, this is where it's at right now. So, rounding out our energy majors is the European giant Shell. Shell offers a similar thesis to its American cousins, but with a slightly different flavor. The company is also focused on capital discipline and shareholder returns, with a dividend yield around 4% range and a significant buyback program. I know a couple of people like, I thought you said shit was 20%. I did, but I'm going from smallest percentage return to the largest percentage return. Now, the unique angle for Shell is its leadership in the global liquefied natural gas area, LGN. In that market, as European and Asia prioritizes energy security, the long-term demand for LNG is incredibly strong. And this gives Shell a growing stream of cash flow that's less tied to the daily swings in the oil prices. Michael says, buy when it's in the trough. Damn right. The risk here is going to be twofold: commodity price risk, just like the others, and the added layer of European political risk around energy policy and windfall taxes. However, it's a global footprint, and essential roles in the LNG trade are powerful mitigants, which you also got to pay attention to. You probably get gas at Shell, Chevron, or Exxon, so why don't you have stock in those companies? Now, tiptoeing to the next. Now, this final name on our small list. Oops, hold on, y'all. I put Shell up there. I was supposed to be putting this one up here. This is a treasury bond ETF. Now, this is going to be the final one on our foundation list that might seem a bit odd. It's an ETF that holds U.S. Treasury bonds. And why is this on a stock watch list? Because income investing, when you're doing that, you always have to know your benchmark. GOVT represents the risk-free rate. As of late March 2026, it offers a yield of around 3.5 to 4%. This is the risk-free rate. And as I just mentioned to you, the rest of the stocks that I just mentioned are in that risk-free rate area. This is going to be the number that you have to beat. Every other stock on this list carries more risk, so it must offer a higher yield to compensate for you. So I keep GOVT on my watch list as a constant reminder of my opportunity cost, not necessarily to invest in, but you can. If a stock I'm looking at yields 5%, I have to ask myself, is that extra 1% worth the business risk? In Q2 2026, with the 10-year treasury offering a real return above inflation, this is the most important question an income investor can ask. It's the anchor for our entire strategy. Now, we move. Make sure that you guys like and subscribe if you haven't done so already, and start mashing those reaction buttons because it's about to get deep. But we're going to move up the pyramid to the core of our income strategy now, for those that are still with us. This is where it gets interesting. With companies and ETFs in the 6% to 10% yield range. They have more risk than our foundational names, but offer way more income while still being high quality stocks. This tier is dominated by the REITs and the BDCs. Quick primer. A REIT, real estate investment trust, is a company that owns or finances income generating real estate. They get special tax treatment, but have to pay out at least 90% of their taxable income as dividends. Issue we have with this when we start thinking about taxation, because they are giving away their taxable income to the shareholders. The shareholders are taxed at normal tax rate. The other companies that I mentioned to you guys, the Johnson and Johnson and all of the oil companies, those companies are going to be on that deferred tax rate. So if you buy and hold it, remember I told you guys the deferred tax rate is 121 days, which is 60 days before the ex-dividend date, 60 days after the ex-dividend date, and the ex-dividend date. If you just buy and hold, you get the deferred taxation. Those gas and Johnson & Johnson, those are the ones that get that. Okay? So I want to make sure that you guys understand. Real estate investment trusts, BDCs, not so much. They're going to be taxed normally. So when you start rebalancing your portfolio, you have to ask yourself, do I want to have 60-40 with REITs, or do I want to have 60-40 with non-REITs, or do I want to have balanced across the board? The more volatility you have with REITs and BDCs, the higher your average portfolio is, the more risk you have, the more taxation you have. But the higher or the lower the REITs that you have, the lower the risk, the lower the dividend returns, the lower the taxation. And you have to find a sweet spot between normal taxation versus exemption and maximum growth. But if you understand that out of 21%, if they took 3% from you, you're not going to be hurting that much in comparison to 3%, and they take 1.5% from you. Big difference. A BDC, or business development company, invests in small and mid-sized private businesses. So think of them as publicly traded private equity funds. So when you are talking about quality REITs, the conversation often starts with this stock, Realty Income. This is the monthly dividend company. This is the gold standard. They own a massive portfolio of over 15,000 commercial properties, making them extremely stable. Mostly single tenant retail spots under long-term triple net leases, where the tenant pays for taxes, insurance, and maintenance. It's one of the most stable business models in real estate. The yield on uh, realty income is currently around 5.3%. It's on this list because the market's fear of interest rates has unfairly crushed its stock price. Yes, higher rates increase borrowing costs for REITs, but blue chip operators like Realty Income can handle that. They have a fortress balance sheet and access to cheap capital that smaller players can only dream of. The risk is tenant defaults in a deep recession or the continued rise of e-commerce. Now, the other thing that we have as a risk here is tenants getting deployed to war. So real estate investment trust took a little bit of a hit because everybody left, thousands of people left. Some of them aren't coming back. However, their portfolio is full of defensive businesses like convenience stores, pharmacies, and grocery stores, the kind that are largely insulated from online shopping. They've paid over 645 consecutive months of dividends, which says everything about the model's durability. 645 consecutive months of dividends. Okay. That's a lot. With 12 months in a year, that's a lot. Now, if realty income is the gold standard of real estate investment trusts, Main Street Capital is the gold standard for BDCs. Main Street provides debt and equity to lower middle market companies. What sets them apart is their incredibly conservative management and pristine track record of not just preserving, but consistently growing their net asset value per share. Main Street offers a regular monthly dividend yield around 7 to 8%, and they frequently pay out special dividends on top of that. The undervaluation is rooted in recession fears. The market thinks a slowing economy will cause defaults in their loan portfolio. While that's a valid risk for any BDC, Main Street underwriting is the best in the business. They focus on the first lien secured loans, meaning they get paid back first, and their portfolio is highly diversified. They've navigated multiple economic cycles without blowing up, unlike many other peers. Our next real estate investment trust is going to be Gladstone Commercial, another monthly dividend payer. Notice how we've been doing this for a minute, and notice how you could be getting, if you hit these stocks before the ex-dividend date, you could be getting paid every month from the day that you buy it, right? But Gladstone Commercial owns industrial and office properties. It offers a higher yield than realty income, typically around 8 to 10% range. And the opportunity here is a classic case of the market throwing a baby out with the bathwater. Sentiment around office real estate is horrible, and for good reason. But Gladstone's portfolio isn't a bench of Class A towers in downtown Manhattan. They focus on secondary markets and properties leased to high quality investment grade tenants on long term leases. Plus, their growing industrial portfolio is benefiting from onshoring trends. Onshoring means here. Now, the big risk is, of course, the office portfolio. If vacancies spike, cash flow will suffer. However, at the current discounted price and high yields, we are being well compensated for that exact risk, especially given the quality of their tenants. And when you do your research on these, I recommend that you take the time to try to grab like 15 of the best ones that you like. Lock those in, put a decent stack against them, see what happens next. And then if you want to, you can add a little bit more to it. But as I told you guys before, that if you have about 15, maybe 20, and they're diversified in different areas, in different markets, you would likely not need to do too much more than that with your portfolio. Because if you have, there's 5 major sectors that you want to pay attention to. And if you have 2 or 3 different companies from each one of those sectors, that's 15. After 15, you're gonna lose out on your average dividend return and not make as much impact in market volatility. You're starting to reach the S&P 500 status, right? But global net lease is going to be another high yield REIT, often in the 9 to 10% range, as the name implies. Global Net Lease owns a diversified portfolio of commercial properties, similar to Realty Income, but with significant international exposure, particularly in the United Kingdom and Western Europe. This global diversification is the core of the thesis, offering exposure to different economic cycles. The portfolio is leased to high quality investment grade tenants with low lease terms, providing predictable cash flows. So the primary risk is currency fluctuations in the euro and pound. Well, the euro or pound can impact earnings. So if anywhere over there that they have fluctuations in their currency, that's going to negatively impact the stocks over here. And there's also going to be tenant credit risks. But the high starting yield provides a substantial cushion. So for investors wanting global real estate exposure and high monthly income, global net lease is an overlooked option as well. He said, explain the trends you are giving investment advice now. A special shout out to Charlie. So I don't understand, what do you mean by explain the trends? Because as I'm explaining the stock and we're explaining the trends, like what do you not understand about the trends, Charlie? Because I told you when you came to the show the other day that this is what we do. We talk about the politics and how it interferes with your money. Then we talk about ways to invest your money. We talk about ways to invest the money, ways to make money. So saving it, investing it, making it. We cover a lot of different things. Talk about different countries around the world to live. We talk about different cultures, because just making money in another country isn't enough. You got to be satisfied where you live, and then we tell you how to fix yourself and improve your decision making so that you don't have to be negatively impacted by your bad decisions. So when you say explain the trends, are you just pointing out the fact that I'm explaining these trends, or do you want me to give you a little bit more explanation about the trend? Because yeah, I'm telling you guys about information about where I know it's a good place to go to invest. Uh, um, so like for example, with one of the trends like we talked about with real estate investment trust, he said you are giving investment options. Are you certified in investments? So if I am giving you public knowledge, Charlie, I'm giving you public knowledge, and I am telling you based on that public knowledge, you should do your own research, and then you should be able to find yourself comfortably investing in other things. I am telling you that stuff exists that you didn't know about that you should go and look at. So, what kind of certification would you expect someone to have to say, hey, I found some undervalued stocks that nobody's paying attention to? What certification, Charlie, do you believe somebody's supposed to have? Because 9 times out of 10, if you a betting man were during sports season betting on your team, and your homeboy comes out of nowhere and they tell you about something that happened with your team or the competitive team, which changes the way you bet. If you had a fantasy football league that you played in, and you got some information from one of the other guys in your league that made them change how they put their lineup, and that convinces you to change the way you put your lineup, what certification to tell you to take a look at this? Because I'm not asking you to buy my product. I'm not asking you to invest in my company. I'm not charging you for the ability for you to go do your own research. He said maybe a degree in Thomas Sowell. I don't see the relevance in any kind of, because I mean with the 3 degrees that I've already got right now, I don't see how any of that would change if I told you, okay, for example, when we talked about Cybertruck the other day, a lot of people came in and talked about how Cybertruck is trash, right? Now, anybody who tells you don't buy that, you can call that financial advice. But people who know the frame bends underweight, the 500-mile projection on the Cybertruck is for the tri-motor, not the single motor or the dual motor. The dual motor is likely getting 300 miles for the range, but that's at an empty vehicle, not a fully loaded vehicle. And the single motor is not getting as much as the dual motor. So if you go max capacity, you're likely not going to see 300-mile range. You're likely going to see 75 to 100-mile range, and that is common knowledge. Now, what certification do you need for somebody to tell you, hey, you should either look into this or not look into this? You say a degree. Well, then what you're basically saying is that your mind is closed to any knowledge that was to any knowledge that could give you insight to something else. Just like when we covered Venezuela, just like when we covered Cuba, just like when we covered Iran, just like we curate all of our information and then we bring it to you like, hey, take a look at this. Just like when we when we talk about how the government is spending money when they're buying $1,000 ink pens to give away to people watching them sign a piece of paper, and he reduced that price to $5. I mean, now I have to have a degree in politics so that I can talk about how, hey, this is public knowledge. You said Milton Friedman was a good listen. But Milton Friedman did not require 32 degrees in order for him to tell anybody anything about, hey, I've seen this and that's what it is. He said, you recovered nothing just like me. I don't know. I get a return on my investments. That's why I tell you guys to look at them. So when I tell you guys, hey, take a look at this, you need to take a look at this. So if I'm talking to you, so you said earlier that I have to have a certification to tell you what my watch list is. That's like saying that I got to work for Target in order for me to give you my wish list for Target. It doesn't make any sense. It doesn't make any sense at all. The logic behind it is that if I'm telling you about different stocks that are undervalued stocks that you either knew about and didn't care about, or you didn't know about and now you know about it and you should care about it, it is now your responsibility to do your own research and then validate and verify that these stocks are in fact in existence and are in fact reasonably priced close to what I'm talking about, showing reasonable percentages close to what I'm talking about. And I collected this information from today. So as time goes on, this show is still going to be there, but the prices are going to change. He said, must suck learning what you learned. No, if it sucked learning what I learned, then I wouldn't be talking about it, would I? I mean, why would it suck to learn? Why would it suck to obtain knowledge? What is the, well, because I don't understand, why do you not hold value in obtaining new knowledge and growth and improving yourself? That's confusing. But anyway, we're gonna move on because I mean Charlie's not willing to learn and grow. So I respect that. You have your opinion. We're going to continue on with our list so that you guys can kind of take a look at what I've been seeing. And our first pick for the upcoming section is an ETF, that is Global X Super Dividend US ETF, DIV. For anyone who wants instant diversification across high yield stocks, DIV is an excellent tool. This ETF holds a portfolio of 50 of the highest yielding stocks in the United States, equally weighted, might I add. So the yields on DIV is constantly in the 7 or 8% range with a monthly payout as well. So the thesis is simple. It's a one-click solution for higher income in comparison to the S&P 500 or something with a lower interest rate. Now, the fund's methodology forces it to buy into beaten down, out of favor sectors, which is exactly where we're finding value today. So the portfolio is a mix of real estate investment trusts, BDCs, and energy stocks, which might likely have a lot of the ones that I had grabbed. The risk is that you are, by definition, buying a cheap stock, and some might be value traps, but the equal weighting helps mitigate the risk of any single company blowing up the funds. That's why we grabbed it. Now, this next group that we're going to talk about, it is a bit different because these aren't pure income vehicles like real estate investment trusts or BDCs, but this category includes companies benefiting from specific uh, um, cycling trends, things like energy surges, as well as some special situations. Now, the yields can be more variable, so they're going to fluctuate as the market changes, but the total return potential is very significant. I've been watching this one since I found it, DHT Holdings. I say that like duh, but no, I mean I watch it since I found it in October, I believe is when I found this one. DHT Holdings. With Brent crude, the entire energy supply chain is swimming in cash. DHT Holdings is a pure play crude oil tanker company. They own and operate a fleet of very large crude carriers, VLCCs, which is what we were just talking about on Monday. Remember when I explained to you the whole scenario, Charlie, about Donald Trump and the 20 VLCCs that came out of the Strait of Hormuz that was allegedly supposed to be gifts to America, but they actually redirected themselves where they were going, which is more than likely somewhere in Asia. This is why yesterday's information plays into today's information. Now, the super tankers that move oil around the globe, that's these VLCCs. The thesis is straightforward. When oil demand is high and trade routes get more complex due to geopolitics, like what we're going through exactly today, the daily rental rates for these tankers are going to soar. DHT has a policy of returning at least 60% of its net income to the shareholders as dividends. So as high earnings surge, the dividends does as well. The yield has recently been in the high single digits, around 9%. The risk is going to be obvious. If tanker rates fall, so will the dividends. This is a very complex business. However, the current supply of VLCCs is very tight. And with strong demand, the fundamentals for the tanker market look good for the medium term. medium meaning like about the next 6 months or so. Now, Chord Energy is an E&P or exploration and production company. They're focused on the Williston Basin in North Dakota. It's a more direct bet on the price of oil. What makes it a compelling income play is its shareholder return framework. Chord has committed to returning 75% of its free cash flow to shareholders through a mix of base and variable dividends. In a high oil price environment like we have right now, the variable dividend can be huge. The company also has a very little debt uh, 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 platform, which is a major sign of quality in the complicated industry that they're in. Now, the risk again is going to be the price of oil, but with a strong balance sheet and a clear commitment to shareholder returns, Chord is an excellent way to get paid handsomely for pure play exposure to high oil prices without having to go through all of the extra effort to uh, uh, call and debrief every oil company in person. Now, this one, this next one I'm about to talk to you about, this one might surprise you. It actually tickled my fancy when I found it. Most people use it. Energizer, the battery company, isn't usually thought of as a high yield stock, but market fears over its debt have pushed the stock down to where it offers a compelling dividend yield. Energizer has been around since a lot of us that are in our 40s and 50s were children. We used to put Energizer batteries and Duracell batteries in our remote control cars, our video game consoles. Energizer and Duracell are like the two household names for batteries, especially rechargeable batteries, right? But no one ever thinks about this kind of company. This is a classic special situation play. Energizer is a consumer staple. People buy batteries no matter what. The company has incredible brand recognition and may uh, uh, take a good position in market shares as far as distributing batteries because they got batteries for every off brand, but everybody knows about the Energizer Bunny. It keeps going and going and going. Duracell, right? The market is worried about the debt taken on for acquisitions, but management is now laser focused on paying it down. So the business generates strong, predictable cash flow to do just that. And the dividend is well covered with a payout ratio of around 40%. That's not share price, that is payout ratio. The thesis is that as the company fixes its balance sheets, the market will re-rate the stock higher. In the meantime, you collect a healthy dividend from the business with a wide economic moat. And I told you out of 23 stocks, we're gonna go through. We're on number 15 out of 23. Make sure that you guys like and subscribe and tap dance on those reaction buttons because this is stuff that you guys never thought possible, and it's out there. And we're continuing as we go on through tonight's show. We're continuing to get to higher dividend pricing. Regional management is. Oops, did I put that one in there? I thought I did. There it is. Regional Management Corp is a consumer financial company providing personal loans to non-prime customers. This is certainly a higher risk area, but that risk is why the stock often offers a high single digit yield. The investment case rests on the idea that The market is overly pessimistic about credit losses. RM stock has been punished on fears that a slowing economy will lead to a wave of defaults. The company, however, has a long history of managing credit risk through economic cycles. The current valuation seems to be pricing in a severe level of loan loss, a scenario that some analysts feel is overly pessimistic. If we only experience a mid or mild recession, it's a bet that management is better at managing credit than the market thinks they are, right? This isn't for the faint of hearts, but the potential rewards are substantial. We have this one is pretty entertaining. Putting the QQQ on the map, the ETF that tracks the NASDAQ 100 on its list might sound crazy. And there's also a QQA that you can look into as well. But this is a contrarian hedge and a benchmark for our entire thesis. The dividend yield is tiny, but its role here is critical. Our thesis is built around the belief that the market is rotating away from the mega cap, AI driven stocks that dominate the QQQ and QQA portfolios. Now, at the top of tonight's show, we had a fan come up and ask specifically about the AI recession. And I was like, hey, I don't have information about that because I wasn't following the AI recession today. But I have it on my wish list, not as a potential buy, but as a barometer. If the QQQ starts to break down and underperform the broader market, it validates our shift to value. If it roars back to life, it could be a signal that our thesis is early or, in fact, potentially wrong. Watching the QQQ versus the energy sector XLE or value ETF VTV is a live indicator of whether our strategy is working or not. And now we get to number 17 out of 23. MicroStrategy MSTR. This is by far the most speculative name on our list because it is a software company that has become a leveraged bet on the price of Bitcoin. Yeah, I even grabbed you guys Bitcoin ETF. The company holds a massive amount of Bitcoin on its balance sheet, and its stock price has a historically tight correlation to the cryptocurrency. So, why is it here? For dislocation opportunities? The crypto market is famously volatile. And so many people ask me, should we invest in crypto? If you know what you're doing. But you can invest in MicroStrategy and they invest in crypto. Safer bet, since you don't know squat about crypto. There are times when MicroStrategy's stock discounts from the underlying value of its Bitcoin holdings, creating short-term trading opportunities. For example, it might trade at a significant premium or discount to its net asset value. This is not a buy and hold for an income portfolio. It is a special situation to watch and get in when you fit in. When fear is rampant in crypto, MSTR can sometimes get oversold relative to its holdings. For aggressive investors who understand the immense risks, this dislocation can be profitable because when everybody else is overselling, you can buy it at a discount. We've now reached the top of our pyramid. So I want to make sure that as we keep going, because we got like 25 more pages left. So we got another 35 or 40 more minutes worth of information to give you guys. And I want to make sure that I remind you guys to like, subscribe if you haven't done so already, and mash those reaction buttons, because if you didn't know, now you know. And as they said with G.I. Joe, knowing is half the battle, right? The more you know, reading Rainbow. I told Michael, I said, Michael, verify it. Peer review podcast. I'll start telling you about the interest rates. Michael didn't come in and say nothing, but Michael, verify those prices. Verify those prices. Look, we're about to get into the powerhouses. Okay. These stocks are going to offer yields 10%, 12%, 14%, and even higher. This is where massive income potential lies. But it also is where the risks are the greatest. This tier is dominated by mortgage real estate investment trusts and higher risk BDCs. So you have to understand what you're buying here. A quick note on MREITs. Unlike equity REITs that own buildings, MREITs invest in mortgages. They make money on the spread between the interest they earn on the mortgage assets and their cost of borrowing. This business model makes them highly sensitive to interest rate changes. And while the agency MREITs will discuss have almost no credit risk from homeowners defaulting, they have a huge interest rate risk, prepayment risk, and book value volatility. These are not buy and forget investments. I watch them weekly. Okay. AGNC is one of the largest MREITs. It invests almost exclusively in agency, mortgage backed securities, MBS, which are guaranteed by government sponsored enterprises like Fannie Mae and Freddie Mac. This means there's virtually no credit risk. The yield on AGNC is consistently in the double digits, often in the 12 to 15% range. The risk isn't homeowners defaulting, it's interest rate volatility. The value of their mortgage portfolio swings wildly with moves in the bond market. They use complex hedging strategies, but it's impossible to eliminate this risk. The thesis for AGNC in Q2 of 2026 is that with the Fed on pause, interest rate volatility should calm down, which is good for AGNC businesses. At a yield of over 14%, you are being paid a massive premium to take on that interest rate risk. Just know that the dividend is not always guaranteed. Now we at number 19 of 23. So we're going to go through the rest of these so that you guys know what you should be taking a look at. Watch your list, check them twice, like Santa Claus, and when you buy, you hold on for dear life. Armor Residential is another agency-focused MREIT. Very similar to AGNC, they also invest in MBS guaranteed by Fannie and Freddie and offer a huge dividend, often in the 12 to 15% range. The investment thesis and risks are nearly identical to AGNC. You're betting that in a stable rate environment that you can collect a huge dividend. One thing to watch with MREITs like ARR is their price to book value. They often trade at a discount to their book value, which can provide a margin of safety. If you can buy an NREIT at 80 cents on the dollar, you have a 20% cushion. However, the book value itself can be a moving target and has a history of eroding. This is a high risk, but it is also a high reward play for investors who can stomach the volatility. 4 stocks left to go. Two Harbor Investment Corp. Uh-oh. Let me go special shout out to Steven. He says stop by on break to drop a light. I'm running the warehouse solo tonight due to call outs. Oh, fuck that warehouse. That warehouse sucks. Special shout out to Steven. I really appreciate you dropping by. When you have time after the show to take a listen to what we got going on, because we're going over all of the stocks to pay attention to for April and May of 2026 as we creep into April. But we're giving you guys, I appreciate that like. And see, this is the benefits of network. I have some individuals like Charlie that aren't really interested in learning a lot of new things from people they don't trust, which I respect. But we also have valued individuals like Stephen and Michael and other people that come to the show on a regular basis that are eager to learn new things that are public knowledge information where you're not being pressured to do squat other than look it up yourself, verify it yourself, and then if you like it, grab it. If you don't like it, it's up to you, right? But you can't say you didn't know it was there. So as I cross over the millionaire mark, those of you who didn't are going to be sitting here saying, oh man, how'd you get there? I took the advice that I gave myself. I followed my watch list. Now, Two Harbors is a unique hybrid MREIT. A big part of its portfolio is in mortgage servicing rights, or MSRs. An MSR gives the holder the right to collect mortgage payments from a borrower for a fee. MSRs are an interesting asset because they tend to increase a value or increase in value when interest rates go up. Since fewer people refinance, I would fucking refinance. If you're overpaying on your loan and the shit's going down quickly, I would refinance the fuck out of it. Drop your because think about it like that. A lot of people are like, oh no, that's a waste of time, it's a waste of money, blah blah blah. Only if you're paying the bare minimum. But if you're overdoing it, if you're paying 3 to 1 and you're driving that bad boy down, you could likely refinance that son, but and drop your monthly payments significantly because they're going to refinance the remainder over the course of the new loan. Yeah, you're going to take a little bit of a cut on your progress, but you're also going to have a massive gain because if you was financing at $2,000 a month and you paid enough to where when you refinanced it, now you're only paying $1,000 a month as a mandatory, you find yourself paying far less. If you were paying at $1,500 a month and then you're able to refinance it and now you're paying it like $500 or $600 a month, you're required to pay far less. The best part about the refinance part is that you can still pay the $2,000 or $3,000 a month, but since you only had to give them $500, everything above that goes directly on the principal. You can pay off that 30-year in 5. If you had a 30-year that went 15 and then you refinanced it for another 30 and paid it off in 10 or paid it off in 5, you can knock that out because there's less interest in the front end because it's stretched across a longer loan. It's cost of doing business as well. Now, this is going to make Two Harbors a potential hedge in a portfolio of traditional MREITs. The company still has significant interest rate risks, but the MSR portfolio helps balance it. So the yield is typically in the double digits, making it another high income option. The complexity of valuing MSRs is a key risk, but it is a compelling name to watch. We got three left. Ellington Residential Mortgage Real Estate Investment Trust, or EARN. I love the way they picked the ticker for this one because you are earning it with this one. This one is phenomenal. Ellington Residential is a smaller agency MREIT with a smaller business model to AGNC and ARR. Their yields is also firmly in the double digits category. Being smaller, EARN can sometimes be more nimble than the giant peers. And the management team has a longer track record in the complex world of mortgage-backed securities. Now, the risks are going to be the same, where interest rate volatility, spread compression, and potential dividend cuts. When looking at these high yielders, it's often a good idea to spread your bets across a few of them rather than going all in on one specific one. But I can tell you that as of today, when I was looking at Ellington Residential Mortgage Real Estate Investment Trust, I was seeing a little over 21% return, between 20 and 22% right now, today. Um, Rounding out our MREITs is our Orchid Island Capital. And I've talked to you about this one since this time last year when we first found it. When I first started covering undervalued stocks, Orchid Island is another pure play agency MREIT offering a very high monthly dividend, often pushing into the 15+% yield range, right now tipping the charts at about 21% as well, slightly lower than Ellington Residential. Orchid Island is arguably one of the higher risk options in this group. It has a history of significant book value erosion during periods of high rate volatility, and the investment case here is a pure bet on a calm interest rate environment. So if the Fed stays on hold and the bond market stabilizes, Orchid Island's business can generate a tremendous amount of income. The stock often trades at a steep discount to its reported book value, which attracts deep value investors. However, the risk of a dividend cut is always present. This is for the most risk tolerant income investors there are. If you can roll with the punches and you want to lean on 20+% volatility, even if you're leaning on this for short-term fast cash generating stocks, buy and hold through the chaos, sell while you're up. It's a good philosophy to have. Our final stock for today is a BDC, but it is a world away from the quality of Main Street Capital. This one is one of the largest and most controversial BDCs. It invests in a wide variety of assets, from first lien loans to equity. Prospect Capital often offers one of the highest yields in the BDC space, sometimes in high teens or even topping 20%, as we've seen for the past 2 months. The reason the yield is so high is going to be the risk. The company has a long history of destroying shareholders' value through dilutive equity raises and a steady decline in its net asset value per share. The management team is also highly compensated, and a major red flag for many investors to look at. True. Special shout out to Kate. So, why is this one even on the list? It's here as a prime example of a potential value trap. The allure of a 20% yield is powerful. But if the dividend is funded by eroding the company's underlying value, you're just getting your own capital back minus fees. So long-term investors should study PSCC as a cautionary tale to understand the critical defenses and the differences between a high yield and a sustainable return. So if you're watching Prospect Capital on a weekly basis and you're buying into the volatility and you're holding on to that volatility while it is in your favor, as you start observing certain situational changes in the company's performance that triggers you to sell before it gets too bad, you can pull out of that company and then redirect your capital, rebalance your portfolio to other more stable real estate investment trusts or other more stable markets in general. You can go directly into energy. You can go directly into medicine. Grab you some Johnson & Johnson, get you some Coca-Cola and Pepsi. You know, you can go into other areas just to rebalance away from the volatility if you're trying to play it safe. Now, that was a marathon, but that's my full quarter to 2026 watch list. We've covered 23 names across the entire risk and yield spectrum. So let's do a quick recap. We started with the foundation, the defensive dividend kings like Johnson & Johnson, the undervalued tech compounder Oracle, the energy and cash flow titans of Exxon, Shell, and Chevron, and our benchmark, which is Gov Treasury ETF. Then we move to the core income engine. And the core income engine is not going to hold 80% of your portfolio, but it is going to generate probably 30 or 40%, if you really want to do it that way, a large quantity of revenue quicker for you to rebalance into your more stable stocks. And that's what I have recommended myself to do with Prospect Capital, Orchid Island, and Ellington Real Estate Investment Trust, is that by balancing out that 20 to 22% volatility, rebalancing it into the other stocks that are 3 and 5%, I get the security of growth from the other stocks, and I get the tax diversion from the other stocks, but I also get the volatility from the main stocks that are being used to generate more dividends that can be rebalanced back into the portfolio, right? The gold standard real estate investment trusts like Realty Income, the best in class BDCs, Main Street Capital, higher yield real estate investment trusts like Gladstone Commercial and Global Net Lease, and the diversified ETF DIV. Next, we looked at cyclical and special plays, the tanker company DHT and the EMP Core Energy, playing the energy boom, the special situation in Energizer, the high risk lender regional management, and our watch list benchmark of QQQ and QQA. We venture into the high yield powerhouses, the Emirates, AGNC, Armor Residential, Ellington Residential, the hybrid MSR focused Two Harbors, the ultra high yielder Orchid Island, and the high risk BDC Prospect Capital as a cautionary tale. The common thread is that all of these companies are in one way or another being mispriced by the market, fixated on last year's winners and terrified of the current macro environment. Putting together a watch list like this is just the first step. The next thing is doing your own deep dive research into the names that fit your personal risk tolerance. The opportunities are out there, but they demand diligence. So if you got value from the detailed breakdown, do me a favor. If you haven't done so already, hit that subscription button. I'm constantly analyzing the market for these kinds of overlooked opportunities, and I want to bring them to you as a finder. We've got about 52 stocks that we have going across the screen at any given time during the show throughout the week. And if there's something better than what I've already found, I'll add it to the list. So I want to hear from you. What's on your Q2 watch list? Are there any high yield gems that I missed? Michael threw a few of them in there. Let me know in the comment section below, because I read every single one of them, and that's where we can all learn from each other as a community. Just like I was telling Charlie earlier today, if your buddy told you about a reasonable thing, surefire thing, good idea, the qualification that you recognize him and acknowledge him as a knowledgeable source of information, that you would take that information under your wing and do your own research instead of just disregarding it altogether. So for disclosure and legal purposes, I am not giving you financial advice to tell you that if you go and buy into this stock that you are guaranteed to get the best returns in the world. This is my watch list. This is my portfolio. This is the portfolio that this show has been monitoring over the last year and a half. So I'm not your financial advisor here on This and That, where we talk about this, that, and everything in between. We talk to you guys about strategies and plans and ways that you guys can learn and invest, and you guys can grow in better ways. So my advice to you is to do your research. My advice to you is to start investing. What you invest in, that is up to you. Okay. And that is one of the things that you have to remember, because in a market that is driven by fear, the patient investors who focus on cash flow and valuation has a massive advantage. So don't just follow the herd. You have to take it upon yourself, do your own research, verify the information. But now that I have given you ones to look at, look up, verify, and confirm, you can now take that information and use that information to benefit yourself. So that's the 2023 Q2s that I'm going to be paying attention to for the month of April and May. Tomorrow, I believe we're supposed to be talking about Kenya, but I'm not too sure. We got a new country that we're going to be talking about tomorrow, and I got some more information I'm going to be putting into the membership. Apparently, since Steven's doing double overtime kind of work, he missed it before I could put it up there. So I'm going to go ahead and take this time and add to his list the information that he needs for his scholarships. Now, these are the things that I do for the members of the membership. I try to provide them with templates that they can use to give them an idea of what it should look like, and then they can take that document and go and draft their own. And in situations that they need legal advice, they can take that idea and work it over with their legal counsel, and have their legal counsel give them more enhanced and more defined information. But by taking this information and bringing it with you, you have a fundamental start as to what you want to look into. Because a lot of the times people don't know what questions to ask because they don't know what's going on. By me providing you with the information that I provide you on the show, you have information to start asking questions on. And then after you start asking questions on the information, that's when you start getting the rest of the information that you needed to be successful. So with that being said, I'm going to start by saying, ladies, as long as the situation doesn't make sense, I'm going to keep asking you ladies to make it make sense. So ladies, please make it make sense. Fellas, I provide you guys with this information to make you guys high value men, not just by raising your income status, but also raising your decision-making skills. And ladies, while this is a male-driven podcast from the male's perspective, you too can take this information and utilize it to make yourselves higher value women. You just have to prioritize where you want to be at for your 20 and 30-year plan, reverse engineer that plan as to how you're going to get started today, and then take step-by-step actions towards achieving those goals. If you keep your eyes and ears open for potential suitors, you can find individuals that mesh well with your agenda, not just entertain your fancy. And you can then find the type of partner that can help you get to your goals a whole lot faster, because two people can make it to $1 million faster than one. Again, I want to thank you guys for coming to This and That. I'm your host, Xander, where we talk about this, that, and everything in between. And I'll see you guys tomorrow.
Higher ground. Used to chase validation, now I validate myself. Building inner strength, putting doubt upon the shelf. No more unnecessary drama, no more wasted time. Climbing higher, constantly making my own climb. Standing on higher ground where excellence is found. My potential knows no bounds. Raising the bar, breaking ground. My network is my net worth. Choose your company wise. Surround yourself with eagles, not with sheep in disguise. Every interaction is a reflection of my brand. Quality over quantity, that's my personal command. I'm not landing on higher ground where excellence is found. My potential knows no bounds. Raising the bar, breaking ground. I'm not just living, I'm manifesting my vision, cutting through limitations with surgical precision. My expectations are my compass, my respect is my shield to mediocrity and chaos. I will never I'm not just living, I'm manifesting my vision, cutting through limitations with surgical precision. My expectations are my compass, my respect is my shield to mediocrity and chaos. I will never yield.